Imagine it's March 3rd, 1998. You're a 34-year-old single mother working as a cashier in Dayton, Ohio. Your car needs a new alternator, or you cannot get to work, and you do not have $200 sitting in a savings account. There's a small storefront on the corner of your street with bright yellow letters that says, "Cash today, no credit check." You walk in. You walk out 15 minutes later with $200 and a smile, thinking your problem is solved. If you have ever wondered why payday loans seem to multiply in the poorest neighborhoods of every city, stay with me. What you're about to hear is not a theory. It is a pattern. It has happened before, in different countries, under different names, across different centuries. And it always ends the same way. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. 14 days later, that same woman cannot pay back the $200 plus the $30 fee. So she takes out a new loan to pay off the old one. This is called rolling over the loan. Within 1 year, research from that period showed the average payday borrower had renewed their loan 8 times. By the end of the year, she has paid back more in fees alone than the original loan was worth. She still owes the original amount. This is not an accident. This is not bad luck. This is the business model working exactly as it was built to work. In this video, we are going to look at how an entire industry was engineered piece by piece over decades to turn short-term emergencies into long-term traps. We will look at real laws, real loopholes, real numbers, and real people. And by the end, you will understand something most people never learn until they are already caught inside it. Before we go further, there's something important to understand about how this system actually works underneath the surface. Picture a fishing net laid flat on the ocean floor. From above, the water looks calm and open. Fish swim toward what looks like food. But the net is built with a special kind of rope. The harder a fish struggles to escape, the tighter the rope pulls. That is the basic design of a payday loan. The loan itself is not the trap. The structure around the loan is the trap. A payday loan is a small, short-term loan, usually a few $100s, that is supposed to be paid back on your next payday, usually within 2 weeks. The fee charged on that loan, when you stretch it out into a yearly percentage, often works out to between 300 and nearly 700% annual interest. To put that in plain terms, if you borrowed $100 and somehow kept renewing that same loan for a full year, you could end up owing several $100s in fees alone, sometimes more than the original loan was worth. Most lenders do not expect you to pay it back once. They are built around you, renewing it again and again. The profit is not in the loan. The profit is in the trap. This brings us directly to the first major point of this story, and it starts with a Supreme Court case most Americans have never heard of. In 1978, the United States Supreme Court ruled on a case called Marquette National Bank versus First of Omaha Service Corp. The ruling said that a bank could charge interest based on the laws of the state where the bank was headquartered, not the state where the borrower lived. This sounds technical, but it cracked open a door that the entire payday loan industry would later run through. Before this ruling, most states had laws called usury caps, which means limits on how much interest could legally be charged on a loan. These caps had existed in some form since the founding of the country, going all the way back to colonial laws borrowed from England. Usury caps were designed for one simple reason. The lawmakers understood that desperate people will agree to almost any terms when they need money urgently, so the law had to protect them from predatory rates. The 1978 ruling effectively let banks shop for the friendliest state. States like South Dakota and Delaware deliberately removed their interest rate caps in the early 1980s to attract banks and the jobs and tax revenue that came with them. South Dakota removed its usury cap in 1981. Citibank moved its credit card operations there almost immediately. Within a few years, dozens of banks had restructured their lending operations to take advantage. It was doing all the real business. Ordinary people had no idea any of this was happening. They just saw a friendly storefront promising fast cash and no judgment. Behind that storefront sat decades of legal engineering, built specifically to make a triple-digit interest rate completely legal in places where it should have been illegal. This leads to the second part of this story, and it takes us to a very different setting, a small town in rural Tennessee in the early 1990s. Here is something I want you to think about before we go further. Why do you think payday lenders almost always open their stores in the poorest zip codes of a city instead of spreading evenly across wealthy and poor neighborhoods alike? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear, and it changes everything about how you see these storefronts. Researchers at the University of North Carolina, and later the Center for Responsible Lending, mapped the locations of payday lending stores across multiple American states throughout the 1990s and 2000s. The pattern was almost mathematically precise. Payday stores clustered overwhelmingly in zip codes with lower median incomes, higher percentages of Black and Hispanic residents, and fewer traditional bank branches. In some studies, payday lending stores were found to be 2 to 3 times more concentrated in minority neighborhoods compared to white neighborhoods with similar income levels. This was not random chance. This was the same logic that drove fast food chains and dollar stores to map population density and income data before opening a location. Except here, the product was debt itself. A man named Alan Jones founded a company called Check into Cash in Cleveland, Tennessee in 1993. By the early 2000s, his company had grown into one of the largest payday lending chains in the country, with over 1,000 locations. Jones became one of the wealthiest men in Tennessee. He owned mansions, sponsored a NASCAR team, and became a major political donor, specifically to fight regulation in state legislatures. This detail matters enormously because it shows the second piece of the trap clearly. It was not enough to build the loophole. The industry then had to spend millions of dollars protecting that loophole from being closed. Between 1990 and 2006, payday lending companies and their trade associations spent tens of millions of dollars on lobbying and political donations across state capitals in America. In states like Tennessee, Texas, and Mississippi, lobbying efforts repeatedly defeated bills that would have capped interest rates or limited loan rollovers. The mechanism here is simple, but it is rarely said out loud on the news. A business model that depends on trapping people in debt cannot survive normals. Through 2014, a company called Wonga became the face of what the British press called the legal loan shark industry. Wonga used flashy online advertising, including cartoon puppet mascots designed to feel friendly and harmless, to market short-term loans with annual interest rates that at their peak were advertised at over 5,000% annually, a number so extreme that British regulators eventually forced companies to display it clearly as a warning rather than a selling point. Just like in America, the mechanism depended on rollovers and repeat borrowing. A 2012 investigation by the UK's Office of Fair Trading found that, depending on the lender, a significant share of payday loan revenue came not from one-time borrowers, but from customers trapped in repeated cycles of borrowing, sometimes taking out more than 10 loans in a single year. Wonga eventually collapsed into administration, which is the British term for bankruptcy protection, in 2018, after the Financial Conduct Authority introduced a price cap in 2015 that limited daily interest to 0.8% and capped total repayment at no more than double the original loan amount. The moment regulators finally capped the structure of the trap, rather than just lecturing about responsible lending, the entire business model that depended on endless rollovers became unprofitable almost overnight. This is one of the most important details in this entire video, so let it sink in. The industry did not collapse because people suddenly became more financially responsible. It collapsed because the legal loophole that allowed unlimited compounding fees was finally closed by law. The trap was never really about individual bad decisions. The trap was about a structure that only worked as long as the law allowed it to work. Most people will never know what you now know. Most people will keep trusting systems they do not understand, assuming that if something is legal, it must be fair. If you are still here, you're not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now observe what all three of these cases have in common, because once you see it, you cannot unsee it. In 1978, America, the legal loophole was the Marquette ruling, allowing banks to export interest rates from friendlier states. In 1990s Tennessee, the mechanism was political lobbying that kept those loopholes open against public pressure. In 2000s Britain, the mechanism was flashy marketing combined with the absence of a price cap on total repayment. 3 different countries, 3 different decades, 3 completely different sets of laws on paper. But underneath all 3 sits the exact same engine. Find or create a legal gap where interest rate limits do not apply. Market the product specifically toward people who have no other fast option for cash. Design the repayment terms so that renewal, not repayment, is the most likely outcome. And finally, spend resources protecting that gap from being closed. This is not a coincidence repeating itself by accident across 3 nations. This is the same financial blueprint, photocopied and adjusted slightly for local law, like a virus that mutates just enough to survive in a new environment while keeping its core structure intact. The rot was never in the borrowers. The rot was in the architecture built around them. This pattern becomes even sharper when you look at who actually gets hurt and who actually profits, because the human cost here is not evenly spread. Researchers from the Pew Charitable Trusts conducted detailed surveys of payday borrowers throughout the 2010s and found that the typical payday loan borrower in America was not an irresponsible spender. The typical borrower was someone already living paycheck to paycheck, often with no savings buffer at all, using the loan to cover basic recurring expenses like rent, utility bills, or car repairs needed to get to work. Pew's research found that the average borrower spent about 5 months of the year in debt to a payday lender, despite the loan being marketed as a 2-week solution. Think about that carefully. A product advertised as a 14-day fix actually trapped the average user for roughly 1/3 of the entire year. Meanwhile, the people who profited were not just store owners like Alan Jones. Major Wall Street investment firms and banks provided lines of credit to payday lending chains, essentially funding the industry from behind the scenes while keeping their own names off the storefront signs. A 2010 investigative report identified several major banks providing credit lines worth hundreds of millions of dollars combined to large payday lending companies, profiting from the interest those companies generated even as those same banks avoided direct public association with the industry's reputation. So the same financial system that denied affordable credit to working-class borrowers was, in many cases, quietly financing the very companies charging those borrowers triple-digit interest rates. The middle-class saver, the single parent, the gig worker without a financial cushion, these were the people caught in the net. The investment firms, the lobbyists, and the lenders sitting several layers removed from the storefront were the ones who walked away financially secure, regardless of how the borrower's story ended. The question is not whether this pattern will repeat. History has already answered that question many times over, across multiple countries and multiple decades. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything about how you read the next no credit check, fast cash sign you walk past. So what did the people who avoided this trap actually do differently? The historical record shows that those who came through this period without falling into the rollover cycle largely shared a few specific patterns. The first pattern is that they had access to even a small emergency buffer, sometimes as little as a few $100s set aside specifically for unexpected costs, which meant the urgent 2-week deadline of a payday loan was never their only option. The second pattern is that survivors often had access to a slower, less convenient, but far cheaper alternative, such as a credit union, a community lending circle, or even an employer-based salary advance program, options that required more paperwork or more time, but did not carry the same compounding fee structure. Credit unionism. In particular, being member-owned, nonprofit financial cooperatives, rather than profit-driven banks, frequently offered small loan products with interest rates capped far below payday lending rates, precisely because their structure did not depend on repeat borrowing to generate profit. The third pattern is less about money and more about information. Those who avoided the trap tended to understand, often the hard way from a friend or family member's experience, exactly how the rollover fee structure worked before they ever needed emergency cash. This is not financial advice, and it is not a suggestion that financial hardship is a personal failing. It is simply a pattern observed across decades of survey data and case studies. That knowledge of the structure itself, knowing that the trap is built on renewal rather than repayment, was one of the strongest predictors of whether someone walked into one of these stores once and walked out clean, or walked in once and stayed for months. Let's go back to that woman in Dayton, Ohio in 1998. In many documented cases like hers from that era, researchers found that initial $200 loans frequently grew, through repeated renewal fees, into total repayments exceeding $800 or even $1,000 over the course of a year, despite the principal amount owed, barely changing. Some borrowers in case studies collected by consumer protection groups described eventually borrowing from a second payday lender just to make the payment on the first, a pattern researchers began calling loan stacking. Multiply that single story by millions of similar households across the United States, the United Kingdom, and other countries with similar storefront lending models, and you begin to see the true scale of what was built here. Not a single predatory business, an entire financial ecosystem engineered over nearly 50 years through court rulings, state law loopholes, aggressive lobbying, and clever marketing, all converging on the same outcome, turning short-term cash emergencies among the poorest working people into long-term, highly profitable revenue streams for lenders who rarely had to face their borrowers in person. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified, licensed financial professional before making any borrowing or lending decision of your own. This video is not for everyone. Most people will dismiss it as just another story about poor financial choices. But if one person in your life is standing outside one of those bright storefronts right now, considering walking in, share this with them. Not because it will change the world, because it might change their world. Subscribe for more deep dives into the hidden architecture of money and power throughout history, and I will see you in the next one.